Hey guys, happy sip day.
Happy sip day. Good morning.
What's up?
Hopefully, we're all sipping on something nice this morning. I'm drinking tea.
Black tea.
Regular coffee.
So boring, Tucker.
I know. I'll step it up for the next sip.
There you go.
So, what do you guys
So
want to talk about today?
yeah, a lot going on in the bond markets over the last few weeks and really over the last couple of years. We've seen a pretty massive shift from super low interest rate environment that a lot of people are familiar with back in the early 2020s, where people had were able to get mortgage rate loans at 2.5%. A lot of refinancings were happening, new homes were being bought. And then 2022, we saw a big shift where the Federal Reserve started raising interest rates. And that was mainly due to inflation being high, being at multi-decade highs. We had over 9% at one point reading. Um, and since that has come down and we're reading in the 3 to 4% range right now. But what has happened is the Fed started cutting rates in September of 2024, and they've done a 100 basis point cut from their rate, which they control the shorter end of the curve. So that 100 basis points means 1%. And then in 2025, the expectation was that they were going to continue to cut up to 4 to 5 times. And after their last meeting, they showed that it might only be 2 times. And the market is not reacting very kindly to that, with rates going from since they first started cutting till now up over another 100 basis points on the long end of the curve. So that's the 10-year. Tucker, you want to talk a little bit what the 10-year is and what that kind of means for the economy?
Sure. Yeah. So the 10-year is the 10-year bond. So essentially, what you will get paid on a 10-year bond. And that is highly tied to, or I shouldn't say highly tied to, but it reflects changes in mortgage interest rates and things like that. So, unfortunately, I think a lot of people, like Nav was saying, were expecting a 4 to 5 time cut this year. And, like you said, it's looking more like a two to maybe three cuts this year, which um, would have, if they did cut it 4 or 5 times, maybe you bought a house during the last year or two when interest rates were really high, like myself. And you were really hoping that rates would come down and you would be able to refinance to get your monthly payment down a little bit. Well, unfortunately, since rates have started coming down, like Nab said, they lowered it about 1%. And unfortunately, the 10-year rate has gone up about 1%, which means mortgage rates have gone back up to close to, 7%, which is not ideal. So it's an interesting time, and I think they're finding that inflation is being more resilient and hard-headed than they originally thought it would be. So that's why they're probably going to have to slow down the interest rate cuts. And there's a few folks out there who might even go as far as saying they might have to do one cut, no cut, or even raise it a little bit if inflation really kind of sticks around and is really frustrating, which is not a great thing. But there are ways to kind of take advantage of it and kind of hedge your risk, so to say. And one of those is a high yield interest account or high yield savings account, which, in times of high interest rates, your bank account and the high yield savings accounts will pay more. So traditional rates are, 5 basis points, 10 basis points, which is a tenth of a percent. Whereas in times like this, they might pay 3.5%, 4%, maybe even close to 5%. And so, that's one way to kind of make your money work harder for you in these times where inflation is kind of being stubborn and interest rates aren't doing exactly what everyone wants them to do.
Right, right. And it's interesting with in terms of bond movements and different ways to take advantage of it. High yield savings account is a simple one because you can open up an online account with a high yield bank, and put your cash there, just let it sit. There's no money market movement risk. other than if rates start dropping, then the rate will go down over time. And that's what we saw when the Fed started cutting rates initially. Was your high yield savings might have went from 4.5% down to 4, down to 3.5, depending on which bank you're with,
Yeah.
because the short end got cut.
I always check mine. It
Really?
always changes. Yeah.
Yep.
And what's happened is the short end has come down from over 5%. It was at 5 point, I think the high was 5.5. Now it's in the 4.3 range. So your high yield savings account is likely in that close to that set. But what happened to the longer end, which controls, like Tucker was saying, mortgages, interest rates for credit cards, most larger lending is that they move along with that sector, which has gone up over 1%. And what might happen is you might say, okay, I don't want to just rent the rate, which is putting in a high yield savings account, and you're at the mercy of whatever happens with the Fed on the short end. You might say, let me buy a 10-year bond, get this higher interest rate now, that's at 4.8% almost. And then if rates were to drop, what happens is bonds move inversely to interest rates. So if interest rates rise, bond prices fall. But if interest rates fall, bond prices rise. And there's a way to take advantage of potentially down the line, bonds, interest rates coming down. And then you can actually benefit from both getting interest at a higher rate and the price of bonds going up. So there's different ways to do that. There's mutual funds, there's buying one specific bond, there's ETFs. Feel free to reach out if you have questions on that. But that's just another way to say, hey, we don't think this high interest rate environment is going to last forever. And at some point, rates might go down. That usually happens during a recession or if inflation starts coming down. So different ways to try and take advantage of what we're seeing right now in the markets. But then the motto is it's higher for longer versus the environment we were in, just 3-4 years ago where rates were super low. So yeah, it's interesting times.
Very,
But
very
don't
indeed.
but don't hesitate, guys. Reach out to your financial advisor. If you have questions, if you want to explore different options, but there's always maybe something you can do.
That's right.
That's right. That's why we're here.
Okay, have a great day, guys.
Thanks, guys.